Hey traders, welcome to Quantsapp. My name is Varun and option writing can be a polarizing subject. Okay, so a lot of traders come and ask me that option writing has a lot of risk, option writing has requires a lot of margin, but there are obviously some positive upsides to option writing with the help of theta decay being in your favor as well as sideways market being in your favor. So there are multiple things that you can consider when you are writing options. Okay, so when you are writing options, the main thing is the high risk, and along with that, the second biggest downside is the higher capital. Right, so you require a lot of capital because the margin required is quite high as compared to simple option buying. So in this video, I will explain how you can go for some low margin or low capital writing methods, as well as how you can limit the risk that you are about to take. Okay, so let us start. The support has been amazing lately that you guys have shown on our videos. So especially on the English videos which I have been recording are quite good. Thank you so much guys. Thank you so much. I cannot thank you guys enough. You are what keeps me going. Okay, so this is web.quantsapp.com. Since I am on desktop, I have opened the web app. But if you are on Android or iOS, there is a link in the description. You will find it as the first link in the description. So you can install the application on our mobile platforms. Okay, so the application is same for both web app as well as for Android and iOS platform. Since we did not want anything, any imbalance on all of those platforms. Okay, so all the data points, all the tools will be similar across all the platforms. Okay, so let us start without wasting a lot of time. Generally, let's say if you are trading indices, because generally whenever we are trying to write options, weekly expiries are always a nice way to look at things, because weekly expiries will always help you in getting that theta decay, because monthly expiries can have theta decay, it cannot have theta decay, whereas weekly expiries will help you quickly book profits at each point. Okay, so in a directional market which we have right now, so if I just open a daily chart of, let's say, BankNifty, so I'll just go to the chart, and let's say if I open 1 day chart of BankNifty or Nifty, right, any chart if I open. Okay, this is a 1 day chart. Okay, this is a 1 day chart. You can see that BankNifty is currently on a nice bull run. Okay, it has been for quite a long time. Okay, BankNifty is on a nice bull run. There have been some dips, but overarching trend you can see that it has been continuously bullish. Okay, so in a trending market which we are in right now, we cannot go for non-directional writing strategies. So we cannot go for those straddles, those strangles, or even those butterflies or condors if you want to hedge those. What we need is a directional trading strategy. So directional writing strategy or directional selling strategy. How will we identify that? So for that, first you need to identify the direction of Nifty or Bank Nifty. Okay, so just go to the search option. You can search for PCR or put call ratio. So if you just search for PCR, you will find Vol-PCR historical. Okay, so I'll just open this up. So for people who do not know, PCR is put call ratio. There are two types of PCRs. One is OI PCR or open interest put call ratio, and one is volume PCR or volume put call ratio. Okay, so both of these analytics are used to identify participation in options. Okay, so PCR can be a decent indicator which can help you identify what is going on. Okay, so OI PCR already a lot of traders have been using. Okay, so OI PCR is generally viewed as from a seller's perspective. So whenever you look at open interest, okay, so open interest is viewed at from a seller's perspective, hence OI PCR is also viewed at from a seller's perspective. OI PCR always has a positive correlation with the market. Okay, so whenever we talk about OI PCR, if OI PCR increases, that means more puts are there. All right, so more put OI rather than call OI. Right, so if OI PCR is greater or if OI PCR increases, that means puts are being traded more. So not being traded, but more open interest is there on the put side. So whenever we look at open interest, we assume that those are writing positions since writers have a lot more risk. So that is why we say that put writing has happened more, hence the market is bullish. Whenever OI PCR decreases, we know that call writing is more, so market could go bearish. Okay. What about volumes? How do we view volumes or how do we interpret volume data? So volume can be used from a buyer's perspective. Now, not exactly a buyer's perspective, but I will explain how. So options volume, it contains a sort of a directional aspect to it. Okay. So let's say if volume PCR increases, that means put volume is higher than the call volume. If put volume is more as compared to call volume, that is a clear indication that more hedge positions are being created towards the put side, or maybe more square off is happening near the put side, right? If volume PCR decreases, that would mean that call side has more hedge positions. So it contains a bit of a directional aspect, and you can actually see whether the writers are scared the market will go bullish or the market will go bearish. So it shows you the fear of option writers, or you can call it the expectation of option writers. Okay. So volume PCR, you can see it is indicated or it is shown with a red line, and the yellow line shows Nifty's future price or Bank Nifty's future price. This is Bank Nifty as of now. You can just say change the symbol to anything else. Okay. So you can see that the yellow line is continuously moving up, whereas the blue line is continuously range bound. So this is true for a lot of times, right? Even if I scroll, if I show you the data from the past few months, you can see that yellow line is moving up, but blue line is always range bound. Now what does this mean? Okay, so it means that volume PCR can never be trending. It means that volume PCR is always range bound. It is always in a range. Okay. So what we have done is we have just added a couple of indicators. We have just added a couple of indicators that show you when you should expect a bullish sentiment or when you should anticipate a bearish sentiment. Okay. So you can see that there are some red triangles, there are some green triangles. Those are shown based on indicator's reversal point. Okay, whenever indicator is reversing, that is how it is shown. Okay, so there are some red triangles, there are some green triangles. Green triangles indicate that Bank Nifty could go bullish. Red triangles indicate that Bank Nifty could go bearish. Okay, so these signals are not always accurate, right? It won't give you 100% strike rate, but if you are going for some credit spreads, there is a good chance that these will give you a decent overall return, right? So obviously when we are writing options, we need a good overall ROI rather than a good strike rate. So that is what will happen with the help of this. Okay, let's look at some signals that it has generated historically. Okay, so on the 4th of July, you can see here, Bank Nifty was trading at 53,166. Okay, the volume PCR had given a bearish indication. Currently, Bank Nifty is trading at 52,578. So if you had entered with a bullish or with a bearish trade, you would have made decent money, right? I'm not saying that you would have made a lot of money, but it would have been decent return. Okay. On 3rd of July, it was showing a bullish sentiment. The next day, Bank Nifty was 100 points up, more than 100 points. Okay. On 2nd of July, it showed a bearish signal, right? It was showing that based on indicators reversal, there was a bearish sentiment. This signal was wrong, which is fine. Okay. On 28th June, there was a signal for bullish sentiment. Bank Nifty was trading at 52,529. Here you can see Bank Nifty went up to 52,709. So that is how you can use this for your weekly expiries, right? You can use this for your weekly expiries. You can help yourself with those weekly expiry trades. So I generally suggest a bull put spread and a bear call spread, right? So bull put spread is where you sell an in the money put option and buy a slightly OTM put option. So with the help of puts, you are creating a selling heavy strategy. Okay, a directional selling heavy strategy. So I'll explain those strategies in a minute, but you can see that historically it has provided really good signals. Some of the signals have gone wrong. I'm not saying that it has 100% strike rate, but for a model that is just showing you the market sentiment on the basis of volume PCR, it has done a fantastic job. Okay, so why do we suggest credit spreads with the help of this? Why not just basic naked option buying? It is because if a market sentiment is bullish, that does not mean that the market will start moving from the next day itself. So that is why we indicate or we showcase credit spreads, because in case if market does not move, or even if market just moves by around 50 points or 100 points, you will end up making money due to time decay. So that is why we go for those credit spreads. Now real quickly I'll explain those strategies. So just go to the analyze section, not analyze section, sorry, the trading section, and you will find strategy builder known as option architect. So just open the options architect. Okay, here you can select any script you want. So it can be Nifty, BankNifty, or any script. Okay, select bullish or bearish, whatever your signal shows. So Vol-PCR signal, whatever it shows, you can just go with bullish or bearish. And bull put spread is a credit spread along with bear call spread. So I'll explain both of those. If I just click on bull put spread, you can see that it is telling you to sell a slightly in the money put option, and it's telling you to buy an OTM put option. Okay, so this can be different. Let's say currently the at the money option is 50 to 500. Okay, so I'll do one thing. I'll sell 50 to 500 put option. Okay, 50 to 500 at the money put option. I'll sell this, and along with that, I'll maybe buy the 52,000 put option. Okay, so slightly further OTM. I'll go with that. Okay, slightly further OTM. Okay, is this good? Is this looking good? Right. So this is how you can go for it. I generally suggest that reward to risk is not that much important. Even if you get a 1:1 reward to risk, it is good. So if you want to get a 1:1 reward to risk, I generally suggest go one strike in the money on the sell side, one strike in the money. So at the money, then you go one strike in the money for the put sell, and along with that you buy one strike OTM. Okay, so not that far off. One strike or max two strikes OTM. So at the money is 50 to 500. So 50 to 400, 50 to 300 maybe. 50 to 300 maybe you can buy. So maybe it will give you decent reward to risk. Here you can see you have a 1:1 reward to risk. If I just hold it till expiry, which is in the next 2 days, I can see my maximum profit is around 2300, right? 2300 is my maximum profit, and maximum loss is around 2200 or something like that. So it gives you a decent 1:1 reward to risk. This is something that you can go for. Okay, so this is a bullish strategy with the help of puts, and you can see it's a credit strategy. How do I know that? Because the net is credit, right? You can see that you are receiving more premium if you just calculate the net amount of it. So you subtract this value from this value, you end up with a credit. Okay, so that is what is going on. Now similarly, if you just refresh it once, or if I just go to here and here, okay, you can select a bearish strategy, and bearish you can go for a bear call spread. Okay, bear call spread will do the same thing. So we'll sell a slightly in the money call. So slightly in the money call would be 52,300, and we'll buy a slightly OTM call option, maybe this one. Okay, yeah, so this again gives you a similar reward to risk. It's a 1:1 reward to risk, 2300 profit and 2300 loss. So this is something that I would execute. So why always 1:1? Because option writing generally has a higher strike rate. Whenever we are writing options, it generally has a higher strike rate. So even if you have a 1:1 reward to risk, it's a good enough opportunity for you. So let's say out of 10 trades, you are entering in 10 trades with the help of this strategy. Okay, you end up winning in 6 trades. Okay, you end up losing in 4 trades. You are earning 10 rupees on each winning trade, you are losing 10 rupees on each losing trade. Okay. Net, you are still earning 20 rupees. So that is the general idea. So that is why if you want to end up net positive, 1:1 reward to risk for any debit strategy or for any credit spread. Okay. So credit spread along with volume PCR is something that you can use. So Vol PCR or volume PCR is the tool that helps you in identifying market direction and at least the market sentiment. And along with that, you use this strategy and overall you have a good enough return in the long-term trading method. Okay. All right. So that is it for me. Thank you so much for watching. Thank you so much for spending this time with me. I hope you guys enjoyed this video. I hope you guys enjoyed the way of teaching as well. The support has been amazing lately. I read all of your comments. So make sure that you keep on showing me ways to improve so that I can improve myself and bring you even more content which is more suitable for your own trading journey, which is helpful for you as well. Okay. So if you need any help with regards to Quantsapp or trading in general, on the top right corner, you'll find a simple helpline number which you can dial to connect with our support agent and they will help you further. Okay. Quantsapp is there in the link in the description. You can just head on over there and install Quantsapp or use Quantsapp directly. And then overall, you can have a good enough trading journey. All right. Thank you so much, guys. Have an awesome trading journey. All the best. And thank you so much for watching. Thank you.